All right, folks. Well, listen, we're going to get started here. It's just a little bit after 1 o'clock on a snowy Wednesday afternoon. So first off, thank you for everybody joining today. We've had these sessions in the past when it's been sunny out and we've competed with the weather. Today, I imagine will probably be one of our best turnouts as everybody is stuck at home or perhaps they're in between shoveling. Anyways, happy New Year to everybody. Like I said, I appreciate everybody coming. And as before I get going on this, I was reflecting about the last couple years. We started doing these sessions about 2.5 years ago, and our attendees continue to grow. And we find them extremely useful, to obviously give an update on a quarterly basis on the markets as well as anything else that's top of mind. Today is no different. We will talk about last year, a little bit of a year in review. And then again, we'll talk about this year and also a little bit about tax season, which is right around the corner. I encourage you guys to ask any questions. If you do have questions, you can put it in the question and answer box. I will answer along the way or at the end. And if for whatever reason we run out of time, if we don't get to your questions, I will circle back with you individually and provide some comments. So without further ado, let's get going. So again, today, year in review. Last year, what did 2023 teach us? We'll talk a little bit about the good and the bad for the outlook for 2024, at least today. It's obviously changing pretty quickly. What was relevant maybe 6 weeks ago is a little bit different today and over a short period of time. Throughout this discussion, we'll talk about interest rates, obviously how central banks' interest rate policy will affect the economy. It's kind of woven throughout today's comments. And then I'll talk a little bit about the housing market. I'll spend a few slides on that, and then we'll wrap up with some tax considerations, some that will be relevant for you, other for your family members as well. And as I said, as we go along, please feel free to put your questions in the Q&A box. So I always start, for those of you that have attended in the past, I generally start with a cartoon, and here's the economy. And again, there's lots of talk about this soft landing. Depending on which headline you read or what week it is, some people feel it'll be a smooth landing. Some think it's going to be somewhat of a bumpy landing. So we'll see what happens. We're going to have to wait to see how time passes. But like I said, there's definitely ways to navigate the uncertainty, which we've been doing over the last couple of years. So 2023, what did it teach us? So, I think the biggest and most common theme that we came up against was inflation and interest rates. It dominated the news from day one. It dominated the news right up to the end of the year. So, if you're looking from where the trends have been, obviously the interest rates have plateaued. If anything, there's a lot of chatter about us perhaps seeing some rate cuts as we head into this year, probably mid to late year. And inflation, inflation peaked in June of 2022, and it's been on a constant decline up to the last couple months. The Canadian CPI number came out last week. The US came out this week, both to a surprise. It was higher than expected. And this is just a little bit of a reminder about how challenging it is for the central banks to drive it down towards 2%, which is their ultimate goal. So when we look at the inflation forecast, and this is partly what's really driving the interest rate discussion, in comparison to where we were before, and again, this goes back to, as it started to peak here, 2021, 2022, and then has been since falling, we're roughly here. We're roughly right around 3%. Central banks, again, want to drive it down towards that 2%. It's really sticky. I will talk a little bit about why shortly. But again, the nice thing, it has been falling, and we are starting to see perhaps some softening or plateauing of the interest rate environment. So what happened in the market? So really, if we go back to 2022 and then we go forward to 2023, it was really a tale of 2 years, and they couldn't have been any more different. In 2022, we as investors here in Canada experienced the first bear market since the 2008-2009 financial crisis, notwithstanding the event-driven COVID meltdown that happened in a really short period of time. But fundamentally, this was our first real bear market. And markets fell that year between 9 to 30+%. The NASDAQ was the worst performer, down about 35%. The TSX and Dow was the best performing, down about 9%. Well, 2023 brought a recovery period where the NASDAQ was the strongest performing market. And then the other markets, the S&P had a nice little rebound, but the Dow Jones and the TSX were much more muted. Now, keep in mind the Dow Jones is a market that consists of only 30 companies, so it's very narrow. It's not a really great representation of equity markets. The better one to look at would likely be the S&P 500. It's the biggest and broadest in the world. So despite the significant rally we saw from the NASDAQ last year, the 2-year number on the NASDAQ is still negative 4%. So we've gone 24 months with the best performing market last year still posting a negative return. And that's the same if we look at the global markets and even the TSX. You know, the TSX is just under. The best performing market has been the Dow Jones. And again, I go back to that. The Dow Jones is just the 30 largest companies. Now, when we actually go on a more micro level and we start looking at the difference between growth companies and value companies, again, a very different story. And I'm going to unpack that a little bit about the reason why. And I've talked about it in some of the previous sessions, but I think it's important to go back and reflect on what's happened in the last 12 months. So when we look at value companies, again, in Canada here, the biggest value companies or blue chip dividend companies that we have are obviously our financials, our 6 big banks, our telecom companies like TELUS and Bell. And then we have our energy companies as well. Value largely underperformed growth companies. Growth companies would be everything from technology stocks, mostly, the big 7, which would be, Apple, Amazon, Microsoft, Meta, Nvidia. These would be the larger growth companies that really drove that top end return. Now, some folks will say, oh, the returns on growth companies, we should be fully invested in those. The reality is in hindsight, it would make sense to own 7 companies. But, if you were to go back to 2022, some of these companies were down 20 and 30%. So for a lot of our folks, a lot of our families, they don't want to see a decline on their portfolio of 30% and then up 40% for a net rate of return of -4. They want to have much more consistent, predictable returns, which is the reason why, pretty much any prudent investor would have a combination of both value companies and also growth companies as well. And now one other thing I should mention before I move on, what's really interesting, we can see in the latter part of the year, for a lot of folks that got their statements, I've had comments where they've said, hey, what happened in the last 2 months of the year? We've had a lot of growth. Well, we absolutely did. So the Fed minutes came out in November. This was where optimism was at its highest about rate cuts going into this year. We can see that after the actual Fed met and then had comments thereafter, we saw significant growth in both value and growth companies. So a large part of the returns came in the last 6 to 8 weeks of the year. From the middle of the year to November was pretty soft. September, October being some of the worst months of the year. So let's talk about these 7 companies. Okay, the 7 companies: Tesla, Microsoft, Amazon, Meta, which is the old Facebook, Google, which is also Alphabet, depending on what you own, Nvidia, and Apple. These 7, what we consider quote unquote mega cap companies, or the mega 7 is what they're coining them. They really were the key drivers of market growth last year. And when we unpack the impact they've had, I think it's gonna be pretty eye-opening. So the first thing to look at, I talked about this in the last session, but the 7 largest companies, which I just mentioned in the S&P 500, at the end of the year represented just under 30% of the S&P 500. Okay, now think about that for a second. The performance of the overall market is largely driven by 7, which means the other 493 companies were somewhat irrelevant. So the concern for me as we head into this year and even next year is if these 7 companies falter for whatever reason, it can have a significant impact on just the overall return of the markets. Okay, I believe some of these value companies, depending what happens with interest rates, are primed to actually have some pretty good growth. Okay, now the other thing that's interesting about the 7 largest companies today in terms of their size within the S&P 500, not only is it significant, but if we go back over the last 40-odd years, the top companies in the S&P 500 have rarely been over 20%. Okay, in some cases, for the most part in this period of time, they probably represented about 15%. So the impact of these 7 companies are significant. Okay, now when you look at the NASDAQ, which I said is the best performing market this year, it actually has even a higher concentration. These 7 companies make up over 50% of the NASDAQ investment or the NASDAQ market, which is really significant. So not only do they have an impact on the growth market, which we expect, it also has it on the more diversified, generally diversified and spread out S&P 500. Now, when we dig a little bit deeper in terms of, again, these mega 7 stocks, this is the U.S. Market cap. Okay. Well, when we look at the big 7 I just mentioned, they have a larger market cap than all of China, all of Japan, Hong Kong, the companies that trade on their markets. Okay. And when we go down here, here's Canada. Canada is really tiny in comparison to global markets. Well, what's interesting is I said up here, these magnificent 7 are larger than China, Japan, Hong Kong, and so on. But check this out. We have companies, Apple and Microsoft, that have a greater market cap than what Canada has. So the influence within the markets are significant. And then globally, we look at it again. If you add up all the country weights here in the MSCI, Japan, France, China, and UK, altogether, it's smaller than these 7. So the rally this year was very narrow. Okay, it wasn't really wide, which means a lot of the companies that trade on the markets, they really haven't had the same growth coming out of 2022 like these 7 have. So again, a lot of optimism for some of these, large blue chip companies that have just underperformed, against the general markets. And when we look at just the overall expectation versus reality, again, we're sticking with 2023, and I showed the S&P 500, which again is the most diversified. Lots of companies, a lot of investment institutions come out with their predictions. S&P 500 targets range anywhere between 3,600, which would have been about a 4.5% decline, all the way up to 4,500 by Deutsche Bank, which would have represented 17%. The S&P 500 ended at 4,769 last year. Again, largely because of those seven companies. Okay. So let's actually unpack what's in store for 2024. So I'm going to look at actually 2 things. I'm going to look at what's good, what we think are the good themes. Then I want to actually talk about a little bit of the challenges that we see, because again, there's uncertainty in the markets, and the markets hate this. So again, what's in store? If we get some Fed help, we'll definitely see better returns by the end of the year than if they stand pat. So first things first, it's always good to start a little bit about why we invest before we actually uncover kind of the common themes of 2024. This is just an example. So a lot of folks, coming out of 2022, a lot of folks were sitting on cash. Some of them just had it in their bank account. They weren't really investing it. Well, this is an illustration of the CPI, okay, the Consumer Price Index or inflation numbers in comparison to what basic savings accounts have paid over the last decade, in comparison to investing in equities, okay, or an equity approach. So what's interesting, if Canadians or investors left their money just in a simple cash account over time, they would have generated a return just under 12%, which makes sense because we were in a very low interest rate environment. The banks weren't paying any cash, pretty much less than 1%. For those individuals, those investors that sat on cash, you were the bank's favorite client, best client. And even today, if you have cash in the accounts, even if you're getting more, you're still their favorite because they're paying you a couple percent, and they're taking that money and they're lending it out in mortgages for 5, 6, 7, and car loans at 8 or 9, and so on and so forth. So, when you have money just sitting around doing nothing, it's actually losing its purchasing power in comparison to the inflation rate, which ran at roughly 2.5% to 3% over the last decade. The inflation rate was, when combined, was roughly 30%, which again is right on their target. Well, for those individuals that actually took some risk, unfortunately, they had to go through 2020, they went through 2016, and even 2022. Despite this volatility in the markets, investors were still better off, okay, because they outpaced tax and inflation and still had money in the bank, for their expenses. And folks, I've been having conversations, and some people on this call might actually, they might have been some of these individuals I've had these conversations with. As you get to the later stages of life and into retirement, things pop up, whether it's lifestyle expenses, health-related expenses, medical, or what have you. There's some peace of mind for folks that say, hey, I have this really big expense, and they don't want to spend money. But it's a reminder. What we say is, we say, hey, listen, this is the reason why you invested over the years. You've invested for situations like this. You wanted to outpace tax and inflation and have your money grow so you could actually use it for various things, whether it's travel, health related, and so on. So again, if folks are sitting on cash, yes, we can get good, strong interest bearing type investments, cash related returns. In a cashable equivalent right now, we can probably get between 4.5% to 5%, which is fantastic. A GIC, you can probably get as much as 6% if you're willing to put it with an institution that is less known and maybe, again, might be a little bit riskier. Big banks right now, a 1-year GIC is about 5%. So you can still get decent money. If you leave it in your bank account, like I said, reach out to us. We can give you some ideas. I believe, whether to lock it in today or to keep it more liquid, there's some pros and cons with each. We can walk you through it and help you make that decision. Okay, so the market cycles. Okay, I've talked about this before. This is a good thing. The markets contract every 5, 7, 8 years. And this just as we go back, this is over the last 50 odd years, 60 odd years, we can see there's periods of time, there's recessions, which are these gray bars, and then the drawdowns during those periods of decline. Okay, here's COVID, here's 2022, and then here's the S&P 500, what happened last year. So what's interesting is the up years are always longer than the down years. Okay, and so we're just on the cusp today as we head out of this initial decline that was somewhat short-lived, 12 to 18 months. And we're likely now in a prolonged upward swing. And again, generally, if you go back to the duration, there's about 4.5 to 5 years of up, and then again less than 1 on the down. This is again on the S&P 500. Generally, bull markets are 5 to 7 years. Bear markets generally are anywhere between 10 to 18 months. So again, this is the good. We're coming out of here. Things have been improving. I do believe the markets will be better off today than what they were 6 to 12 months ago, providing we get the right direction from the central banks. Okay, we're in the midst of, again, some folks have seen this. We're in the midst of kind of this next wave of innovation cycles. And what I mean by that, if we go back over the last, couple hundred years, in the early years, we can actually see, the innovation wave was water and textiles and iron. And as we move through electricity, chemicals, internal combustion engines. Well, the last two waves, the fifth wave is really digital network software, new media. So again, you think about the internet. Today, it's a snow day for a lot of folks. Generally speaking, we would have canceled this. Everybody would have been at home. Today, we just pivot. We're able to do these things virtually. That's that fifth wave, okay? The sixth wave, as we're on the cusp of it, the big talk obviously is with AI, robots, drones, clean tech. So here's where we are today. So it's in its infancy. Obviously, there's a lot of talk. These are why these mega sevens are doing extremely well with a lot of the AI. It was interesting. 2 days ago, the Dow Jones was down, just under 1%, but some of these chip manufacturers and tech companies that posted gains for the day. The question is how long and how sustained can this go before we see somewhat of a correction? So again, we're heading into this sixth wave. I think this will be good for the markets. The other thing, and I talked about this earlier, the velocity of cash. There is more cash sitting on the sideline. We haven't seen it this high since the financial crisis in 08 and 09. Okay, coming out of 08 and 09, we can see how quickly cash moved from the sidelines into the markets. And we got down to record lows, and it's stuck this way for quite some time. It was only since 2018-19 when the markets got a little bit choppy where we started to see more flows into cash accounts or cash equivalents. And then we can see here 2022 a significant upside. Okay, and that's partly because of just fear in the market. The second one is because you could get 4 to 5% in something, and people were comfortable with it. Even though they were still behind inflation, they were still comfortable with getting 5 to 6%. So the reason why this is a good thing, and I lived through 2008 and 9, folks, what generally happens is it's like a slingshot. All this money, it doesn't evaporate. It just moves. It rotates. And then like a slingshot, it stretches, and all this cash gets piled up on the sidelines. And at some point, there's a catalyst where it's like you let go a rubber band and all this cash comes flying back into the market. And that's what we saw late in November when the Fed minutes came out, there's a lot of optimism on rate cuts, and all of a sudden we had this big upward trend in the markets, velocity we hadn't seen in months, if not years. So this velocity, this level of cash is going to be a benefit. The challenge is if you're sitting on the sidelines, you could actually miss out quite quickly because it'll move fast. Okay, and then I talked about the S&P 500, about what the targets were starting in 2023 last year. So here's the targets for 2024. Deutsche Bank, which had the most aggressive target last year, it still has the most aggressive this year. And again, it's modest. We're at roughly 4,700, 4,800 level here on the S&P 500. So that's only a move of roughly 5 to 6%. So they're not expecting great things out of the market. And on the downside, you can see actually on the low side is down 5 to 6%. So what a lot of these analysts are saying is, I think we're going to have just a really, really boring year. I think otherwise. I believe if rates cut, and so long as we don't get some geopolitical uncertainties ramp up, I think we could have a fairly decent market this year, providing things go as we anticipate. So that's the good. Let's talk a little bit about not the bad, but what we need to be aware of. And these are the ones that we know about today. Okay. And a lot of these ones, as you read this slide, these are ones that, you're already aware of. We obviously have the geopolitical risks, obviously overseas, Ukraine, Russia, Israel. We have the Red Sea right now, which is starting to escalate a little bit. All of these things create uncertainty in the markets, okay? And the markets, when there's uncertainty, they tend to struggle a little bit, okay? There's a U.S. presidential election that's coming up in the latter half of the year. They're not great candidates, regardless. I'm not going to get into politics, but regardless of where you sit, if you're like, the Republican candidate or the Democratic candidate, they're not the best, in comparison to what we've seen in previous years. So, it's going to be interesting to see what unfolds. On one end, we have somebody who's on the verge of potentially getting incarcerated, or who is in the courts a lot. And then the other one, I'm surprised they made it through this term, let alone if they run for another term. So again, I think there's some concerns with both of them. The former one, obviously, is more pro-business, which I think would be good for the markets. But like I said, it creates a lot of uncertainty. And then again, there's, the U.S. deficits, there's consumer debt that we need to be aware of. And then the biggest one here is obviously if inflation picks up, and the rate hikes are going to be really key this year. I think it'll really drive what happens in the markets. So let's look at interest rates. Okay, so this was December 13th, 1 month ago, 5 weeks ago. Okay, these were the headlines, and it's a little bit of a busy slide, I get it. But the headlines mostly were very optimistic. Indicate 3 rate cuts in 2024. Fed holds key rate steady, signals rate cuts on the way. Some have predicted as many as 5 to 6 rate cuts this year, folks. Okay. This was 5 weeks ago. Okay. This was this week. Okay. Fed will be slow to cut interest rates in 2024. Interest rate cut forecast for 2024, too optimistic. So now you're getting all these investment professionals and institutions saying, hey, let's slow the horses a little bit. Okay, we may not get rate decreases as quick as what we anticipated 5 weeks ago. Guys, this is a very short period of time, and this is exactly what's the challenges with navigating the news right now, is nobody really knows what direction we're going. And the challenge right now is that CPI, inflation, is trickling up, which is actually problematic, which is one of the reasons why it's putting some of these rate cuts on hold, okay? The other thing that's a challenge for rate cuts is the job market. So this is Canadian unemployment, okay? It's still really strong. If we look at it, this goes back over 8 years, 7, 8 years. We're near a low, okay? So, there's still a lot of job creation. In Canada, it's a little bit manufactured a little bit because we have a really significant amount of folks that are immigrating to the country. So it props up not only our real estate market, but also our jobs market. So we get a lot of growth because, the government has a plan to strengthen its economy through its immigration policy. The other issue with the jobs is it's just vacancies and job postings are going down. So it's actually interesting. We can see here in the last couple of years, early last year and onwards, we can see actually there's been a decline in vacancies and job postings. And I have some folks that have actually been bought out of out of positions, or they've stepped back in the short term or what have you, they're having a tough time actually finding another job. They're very selective. But that being said, unlike a few years ago where there was a lot of a job availability and the employee held the cards, it's actually the other way around now. The employer, they're not hiring as quickly. Therefore, the individuals looking for jobs have to be a little bit less selective, unfortunately. But strong job growth impacts whether the central banks are going to cut rates. And here's an idea. Here's just a quick analysis. When could a rate cut happen? Most of the biggest percentage of folks that were surveyed think it'll actually probably happen, in the second quarter in June. I think kind of the same. I don't see a rate cut here in Q1 unless the market starts to deteriorate and get really sluggish. But I wouldn't be surprised if we see one mid-year and then onwards. And again, maybe 2 to 3, possibly 4, depending on where we're at from an economic point of view. But 2 to 3, I think, would be reasonable. All right, let's move on. The second piece is, again, I've talked a little bit about the geopolitical risks and some event-driven risks. We talked about the inflation rate, which is and interest rates, which will be big. Third one will be the recession, will be the health of the economy. And this is a slide I showed recently. This was mid-2023 last year. And this was the consensus of folks surveyed when they expected a U.S. recession. And almost 2/3 of folks felt that there would be a recession within the 12 months. So by mid this year, we would be in a recession. Okay, and that's what it looked like as recently as 6 months ago. Well, fast forward to today, and we look at the probability of a recession. This is in the US. We'll talk about Canada one sec, but it's now actually dropped below 50%, actually almost below 40%. So things have been improving. The likelihood of a recession or scurrying recession looks to be declining. In general, I don't know how we come out of high interest rate environments and not dip into a recession. So don't be surprised if they do announce one at some point. I wouldn't panic, because generally what happens are markets lead into a recession and they lead out of a recession. So, by the time they actually announce a recession, it's usually backwards looking. Markets and economies have started to pick up. But again, depending on what happens with interest rates, consumer spending, we could actually see a recession or an economic slowdown. All right, and here's in Canada. So just really quickly here, in Canada, this is just looking at real GDP. This goes back over the last 50, 60 years or so. Again, gray bars here are the recessions. We can see when we've gone through recessionary periods, GDP falls. A technical reason for a recession is back-to-back negative GDP quarters. That's what signifies it. Well, if we look here, this was again 2008, 2009. Here's 2020. Well, here's where we are today. This is the forecast. This is reality right here. This is the forecast of where they see GDP going. So again, wouldn't be surprising, and if we could already be in a recession, to be honest, already. But that being said, the economy continues to plug along. People are traveling. People are spending. But that brings us into some problematic issues in terms of consumer spending, which I'll talk about here in one sec. But again, GDP is slowing, so recession is probably on the table. Okay, and then pivoting to consumer debt, and this is what I was talking about. Folks, consumer debt, for folks on this call, it might not be as significant, but across the country, it's a big issue. There was a recent survey done by M&P, the accounting firm, and Canadians, in the last year are making only minimum payments on credit cards or line of credit. It's the highest it's been in 3 years. Okay. The second point is we have a lot of mortgages that are coming up for renewal in 2024. Okay, and for folks that are renewing, mortgage payments could rise as much as 20%. Now, there are some analysts out there that think that the amount of mortgage renewals will not have as significant of an impact on the economy as what some folks believe. But regardless, if Canadians have less money in their pocket, that means they have less dollars to spend in the economy, which actually hurts it. Okay. In the last year, 1 in 5 Canadians took from savings. They took from savings, home equity, RSP, alternative methods to pay, their debt or their day-to-day expenses. The challenge with this, folks, is that if people continue to bridge their debt obligations, at some point they're going to come up to a point where they're going to have to make a change rather than accessing investments, line of credits, credit cards, or what have you. What's going to happen is they're going to stop spending. And the challenge with that is once they stop spending, it means the economy becomes more sluggish. Okay, not as many people are out buying. So that's where the government may have to step in with either tax rebates, some sort of initiatives to essentially continue to make people, to get people out there to put money in their pockets. And one of them is, cutting interest rates. But again, we don't anticipate that here in the near term. And then the last one, and I think this is a really important one, Canadians' debt, Canadian payments, it's taken a toll on people's mental health. I think this is critical. Obviously people become less productive. There's studies out there where productivity, Canadian employment productivity is at all-time lows. So again, we need to have this fine balance. And I think the Bank of Canada is trying to manage it. They're trying to manage inflation. They're trying to manage debt. One of the other issues with central banks and interest rates, they want, as much as they're trying to deal with this, they don't want to cut too quickly because, again, obviously the housing market, as they cut, they're a little bit fearful that the housing market might really take off, which is problematic in itself. Okay, it's a good segue. We're going to jump into the Canadian housing market. So we've covered two things. We've covered 2023, we've covered 2024, and now the third thing we're going to talk about the Canadian housing market. And what we see are some of the challenges within this space. So when we actually look at interest rate policy, and this again goes back to last year, and this is actually a really good chart. We really don't know what's going to happen with real estate when they cut. We have some ideas. We obviously think if they cut, people I think are going to jump in. December was a really good month for sales because a lot of people wanted to get in by the end of the year. They wanted to lock in those mortgages. But here's a good example, and this goes across a number of cities across the country. What's interesting is home sales. When the Bank of Canada paused, home sales increased, and you can see in Vancouver it actually increased quite significantly. Okay, but when the Bank of Canada retreated after rate hikes resumed, or after the housing market, once the Bank of Canada started to hike rates, we can actually see the markets actually tailed off. So what this would tell us when we actually look at the most recent data is if rate cuts occur, okay, and money becomes cheaper, there will likely be an influx of buyers that are going to want to get in sooner rather than later. So in Vancouver, that's going to be, I think, a fairly significant, event. And we're seeing even today, prices continue to get cut. Properties are sitting on the markets for longer periods of time. But again, if you get cheaper money and the payments get more reasonable and people are more optimistic, again, I believe Vancouver real estate, which is some of the best quality across the country, will pick up. And again, this is what the central bank, the Bank of Canada, is concerned about. So again, this here looks at Canadian housing starts. Okay, here's another data here. So what's actually interesting, I mentioned earlier, we have a significant amount of immigration that's coming into the country. The government, again, it's one way, they're one tactic they're using to stimulate the economy and keep growth going. Well, what's interesting about this chart is when we look at this blue line here, the housing starts, you can see have actually increased here in most recent months, okay, despite MLS sales actually going down, despite higher interest rates. This is somewhat of an anomaly. Generally, what happens is housing starts tend to slow down when interest rates get high. So the question is whether this can be sustainable, okay? I am hearing, projects that pre-sales or what have you, especially in Toronto and in the Greater Ontario area, you're having developers that are actually pausing projects because the cost of goods and borrowing costs are just getting too high. So long as we get continued growth on the housing starts, and again with immigration coming in, it'll keep the real estate market a little bit more at bay. But if for whatever reason these actually start to dwindle, again, another reason why prices may be on the rise. And then when we look at the rental market, I have two slides here which I think are pretty telling. There's just so much demand for rental properties, okay, but there's very little supply. So what's happening is rental prices. The cost of rent is actually going up significantly, especially here on the West Coast in British Columbia. We've seen that significantly. So when you look at the average, again, over the last little bit, the average rent increase has gone up 21%. BC is actually even higher, 26% a rental increase is happening. Again, there's just so much demand from, immigration that's coming. A lot of folks are also selling. They'd rather actually move into condos or rent. The government here locally obviously are trying to stem that a little bit. They just have a new policy in place about short-term rentals. That's another reason why you might see a few more houses come onto the market. But again, if we get some rate cuts, I don't think they're going to last too long. And then when we just look about renting in terms of cost, which is really surprising, Vancouver has one of the highest rents for properties, yet it's one of the most unaffordable. And the way to read this chart is the blue lines here are the minimum wages of the various cities. And then the purple, burgundy here, or red that you see, this is the hourly wage needed to afford a 2-bedroom apartment. Okay. So in BC or in Vancouver, you need to make almost 2.5 times more of the minimum wage to essentially afford a 2-bedroom apartment. So for those of you that actually have kids, grandkids, my daughter's 19, folks, 19 and a half. For some of you, that's a surprise. For a lot of you, you've known her since she was 3 and 4. I often wonder how she's going to be able to afford getting into real estate. It's really difficult. To fill her car nowadays. She has just a little small car, costs her $100 in gas just to fill it for a couple of weeks. When you start to tack on all the living expenses, general lifestyle expenses plus rent, and the tax that we pay, it's difficult. But again, there's a lot of folks coming in that are supporting these levels. So hopefully we'll actually see a little bit of these come down just for the sake of folks that live in Vancouver. But it's not a Vancouver issue. It's right across the country. And so long as the demand stays great, rental prices will continue to stay high, and real estate should likely stay fairly consistent. So from our point of view, obviously, we still favor income generating real estate. I bring this up only because, if we are going to buy real estate in a portfolio, I'd rather have something that pays our families some money. Traditional ways to buy real estate are in REITs, which are publicly traded real estate securities. The problem with that is they go up and down in value and the market goes up and down. They're very interest rate sensitive. So, obviously a lot of folks on this call, we access real estate via the private side, multifamily income generating type properties, which is the most consistent in terms of returns, lowest drawdowns. The other one that we really like, we like storage, we like student housing. The nice thing about student housing, as people come into the country and are on campus, they either stick around for a couple of years or they move out, which allows the owners of those companies the ability to actually increase the rental rates to stay at, with the market. So again, private real estate has been very consistent over the last 3 years, have averaged roughly 9%. If we look at publicly traded REITs, their average return over that same period of time is probably -4. So this is what the smart money's doing. This is what a lot of pension plans do. CPP, Ontario Teacher Pension Plan, and so on. This is the space that they play in, and this is where we like to have some exposure as well. All right, I'll wrap up. I got about 3 slides left, guys. I've been talking for about 40 minutes. I promised to probably talk about 40 to 50 minutes and then answer some questions. So we're right on time, which is fantastic. I do not want to keep people from shoveling their snow. I know how much people love it, including me. So I will attempt to stay on track. So some tax tips to start the year. So some of these actually won't be relevant for the folks on this call, but it's still good to know for those that have kids or grandkids or what have you. For those folks that are still working, obviously contribute to an employer RSP, especially if it's a matching arrangement. You always want to take the contribution that is provided to you by your employer. In some cases, actually in a lot of cases, what we've done with a lot of families is we allow it to accumulate in the employer plan, employer RSP plan, and then once every year or so we transfer it into their own self-directed accounts. That way they can actually have more access to different investments, stocks, ETFs, funds, what have you. Generally, when you're in an employer contribution arrangement, they pick and choose what is accessible for you. generally one company. You might get 2 US equity, 1 Canadian equity, and so on. But again, you can look to say, hey, does my employer have a contribution plan? A new one here. This is, again, for those of you that own, this doesn't make sense, but again, great one for kids. There is the first-time home buyer savings account that just came out. We can now open them for folks that are 19 and older here in BC. What it essentially allows the parents or the individuals to do, they can actually put in $8,000 a year. They actually get a tax deduction for that, and over the lifetime maximum is $40,000. So over 5 years, $8,000 a time. They can actually use that. They can pull it out fully tax-free. It's very similar to a tax-free savings account. It's kind of a hybrid between an RSP and a tax-free savings account. It allows you to put money in, get a tax deduction, grow entirely tax-free. And when they take it out, they can use it for a first-time home purchase. Okay. It's actually, again, it might seem like a small amount because we're in Vancouver, but everything helps. Okay. That's number one. Staying on the whole property purchase, keep in mind there's also the RSP, first-time homebuyer plan, which allows the government allows individuals to take money out if it's their first time purchasing a home. They can take money out and then they have the option to pay it back over a 15-year period. If they don't pay it back, then that withdrawal goes into their taxable income. But again, when you combine these different government benefits or initiatives, again, you can really maximize what you're saving for a home purchase. If you're self-employed, we've talked about this before, but if you're self-employed, ask yourself if you're turning your personal health expenses into tax deductions. Okay, we call it a private health services plan. Essentially, what it is, and I'll give you an example for myself. I'll talk about my daughter. So years ago, she had to get braces. She had to get braces. And I can't remember how much it cost. Let's just use a round number, $10,000, which I think it was a little bit more than that. But if I was going to pay $10,000, or as a family, we were going to pay $10,000 out of our pocket, we likely would have had to take out $18,000 to $20,000 or earn $18,000 to $20,000 to net out $10,000. Okay. And then that would have been paid to her orthodontist. Well, if you have a corporation, which I did, and for those of you here that are also self-employed or what have you, I could actually set up an arrangement that was above board with CRA. Okay, it's nothing unique or it's all above board. Where I would set up an arrangement, it wouldn't be it's not overly a costly arrangement. It's like $150 to $200 to set up. What it would allow me to do is to take that personal expense, submit it through this third party company that would essentially adjudicate that claim. And if it's approved, which they have it's very broad of what they approve, then I would actually be able to get money out of my corporation tax-free, and then that bill would go to my corporation and be a tax deduction. Okay. So in general, I would have been saving, I don't know, about 20 to 30, 40% on those health expenses because I could turn it into a corporate tax deduction versus personal. Okay. So for those of you that don't have something like this, or you're not sure if you have this, just send us an email and we can actually send you some information on it. And just so you folks know, we don't actually get anything for setting these up. It's just the right thing to do. Most incorporated or self-employed individuals, they have these types of things in place. Unless maybe their spouse has a benefit plan at work, maybe they don't. But again, above and beyond whatever's not covered through your employer benefits can actually be run through here. Okay. On the incorporated side, for a lot of folks maybe on this call, they've already been taking advantage of these tax sheltering. In 2019, the Income Tax Act changed within a corporation. Passive tax became, a higher tax rate. Within the corporation, you can actually put some investment strategies in place that you have to do through an insurance company. It allows you to essentially tax shelter money in the corporation. It allows you to get it out on a tax preferred basis. When you pass away, it fully comes out to your beneficiaries tax-free instead of tax being paid to CRA. There are a number of benefits in terms of this type of structure. If you have not asked about it, or this has not been brought to your attention, then we should chat about it, at least educate you and determine if it's something that's worth looking into further. For those individuals that can contribute to a registered disability plan, an RDSP, this is yet another government benefit or government strategy that you can actually open up an RDSP and they actually give you free matching money so long as you qualify. And this is pretty much for kids and then folks in their middle age that can actually do this as well. There are some deadlines to get these in place, but again, if you qualify, it can be very advantageous. Okay, and then the last one here, contribute to RESPs. For folks, I talk a lot about gifting. A lot of people are saying, "Hey, I'd like to gift to maybe my kids, my grandkids, or whatever." So again, folks that are kids that are younger, setting up RESPs or actually gifting that way, the government will match up to 20%, up to a specific amount. So again, it's free money from the government. It might not be relevant for some of the folks on this call, but for others, these are things that you should be doing. And sometimes you don't have to get cash to put in. Like I said, if you have investments, we can always move some of your investments into some of these different accounts to help out. With the FHSA, I just opened one for my daughter. We're funding it together because, again, at the end of the day, if we're going to help her, I'd rather her get deductions and get tax-free growth than just helping at a later date. Okay, be tax aware. Like I said, 2 more slides. Be tax aware. So investment income, I talked about this previously when I did the tax session. So key thing here, folks, is depending on the types of income you earn, interest income, eligible dividends, and capital gains, here in BC and actually across the country, they're all taxed differently. So what's important is that you're aware of this, and then within your investment strategy, within your plan, we want to try and minimize the amount of tax that you pay along the way. So one of the things that we often look to do is we try and position certain investments in tax-preferred accounts if they're higher tax income. So as an example, if we can actually tax shelter some interest-paying securities that are providing interest income in an RSP, and we can have capital gain producing or dividend producing on the outside in your non-registered accounts, it means you actually just keep more money in your pocket. Okay, I know that sounds a little bit redundant there, but let me give you an example at the bottom. So if you were to earn $10,000, keep this math really easy, $10,000 in Canada, the top marginal tax rate, 53.5%. If you receive interest income, you only get to keep $4,650. So $5,350 goes actually to the government. Okay. If you were to receive capital gain income, only half of that is taxed. So out of that $10,000, you get to keep $7,325. So you can see a significant tax savings between interest income and capital gains. Well, dividend income is somewhere in between. Okay, dividend income is still more significant. So again, we're at a situation right now that there might be some folks on this call that are sitting with money in a GIC or in a bank account earning interest income. Okay, well, I mentioned earlier, again, depending on the time frame, depending on the risk and so on, we'd have to have that conversation. But you can get into large cap blue chip companies, our banks, there's utility companies, there are telecom companies, things that you understand that we use every day. You could build a portfolio yielding roughly 6%. Okay, 6% in dividend income versus you getting 5.5% in a GIC. All right, not only are you getting a better income or cash flow, you're also getting to keep more money in your pocket because dividends are taxed at a lower rate. I hope that makes sense. If it's a little bit doesn't make sense or you have questions, flip me an email, flip the team an email. We'll get back to you. But again, this is the power of understanding taxation on income you're receiving. Okay. And then Riffs. I'm going to talk a little bit about Riffs and lifts right now, folks, because I get a lot of questions about, folks that have to convert Riffs. If you're 69, 70, you start thinking about it. So what happens is when you actually hit age 71, and you have an RSP or a locked-in account, the government requires you, it's a mandatory rollover to a RIF or a LIF, okay? A RIF is when it's an RSP, a LIF is when it's a locked-in account. It is a non-taxable event, meaning it simply goes from the RSP to a RIF. We open up a RIF, a separate account. It rolls over. Everything that's in your RSP can be held in the RIF. There's no differences, okay? At 72, the government mandates that the annuitant or the account holder makes a minimum withdrawal. Okay, so I'm going to use an example of $100,000. If you are age 71, by the end of the year, you have to move your RSP to a RIF, and at 72, you have to take out a minimum. So let's say on January 1st, the year that you're 72, your account value is $100,000. The minimum amount you would draw out is 5.4%. Okay. So on 100,000, that's $5,400 that you have to draw out. Okay, the other 94,000 and change can stay in the account, but the 5,400 has to come out, has to be paid to you. Now, it doesn't have to go to your bank account. You can move it into another account, a non-registered account, TFSA or what have you. It's just they have to see a withdrawal out of that account. And it's really simple. And then 1 year goes by. And by the way, you can do this as a lump sum or a monthly withdrawal or what have you. Well, the very next year at 73, you have to do the same thing again. But because you're 1 year older, the percentage, the minimum goes up. Okay. So let's just say the account was valued at 100,000 again after that 1 year. Well, then you'd have to take out $5,530, $5,530. And that continues to happen year in and year out. Okay. Now, if you're younger and you set up a RIF, the percentages are less than the 5.4. Okay. And this is based on today. So again, very, very simple. It's the government essentially wants, RSP is to save money. A RIF is to take money out. Okay. Now a LIF is actually really similar. A LIF is actually, you're required to convert it to, locked into a LIF. But the difference is there's a minimum and there's a maximum. Okay. And on the RSP, I didn't make that clear. There is no maximum on an RSP. You can take out as much as you want in any given year. But on a locked in or a LIF account, you still have that minimum amount. That 72 is the same amount, 5.4. But the maximum amount that you could actually take out, 8.71%. So as an example, if you have $100,000, you have to take out at 72, 5,400 or 8,710, somewhere in between there, not more, not less. Okay. So again, RIFs and LIFs, non-taxable events can hold the same types of money, still grows tax deferred. The only difference is you're required to make a withdrawal. All right. All right. Now, last little bit, key dates for income tax, folks. Okay. Because you're going to start getting your income tax packages soon. So I'll just go through it. RSP deadline, leap year this year, folks. 2023 maximum limit is $30,780. Okay, so you need to get those checks or electronic deposits in before February 29th. If you give a check on the 29th, it's tough because we need to get it actually deposited. So you should start thinking about this. You should start doing your math about the amounts that you can put in. Okay, number two, TFSA amount has gone up to $7,000 this year. So last year went from $6,000 to $6,500. This year it's gone from $65,000 to $7,000, which is pretty cool. Okay, spousal loan interest payments. So for anybody that has a spousal loan still in effect, which a lot of people do because they're grandfathered, what I mean by that is if you set up a spousal loan years ago at 1%, that's prescribed rate, that stays at 1% for the life of the loan. So for a lot of folks, they'll keep it in place because prescribed rates today are 2 to 3 times. I think it's 3 to 4% now. Okay. But those interest payments need to be made by January 30th, 2024 here. Okay. In the next 2 weeks. Tax documents. These will start to get delivered late January. You're going to start seeing your summaries start to come in. That comes directly from Harbourfront. But then you're also going to get T-slips. T-slips also start to come in, but not until after January. T-slips will come in between sometime mid-March or actually February to end of March. And here's what some of them are. Trading summaries, T5008s. February 29th is when they'll start. And they'll continue to come in through the month of March. T-slips, T4s and T5s, again, will start in February 29th. And then T3 slips, there's generally multiple runs. These will typically start sometimes a little earlier, but mid-March to the end of March. Now, folks, I understand everybody wants to actually file taxes early. I get it, okay? But unfortunately, these T3 slips, I have no idea, and I've said this to some of you before, I do not know why CRA does not standardize this earlier. Because what happens is this is the requirement the government mandates to have them mailed out. And generally, Canada Post is busy at that time of year. We don't get them until the 2nd to 3rd week of April, and then we file roughly 2 weeks later. So we do our best if we can get them to you sooner, but unfortunately, we're at the mercy of some of the other financial institutions and the government's date. So again, we've never had issues with it, but just be mindful if you're really looking to try and file early, some of these tax documents just won't be available. But we'll do our best to help you guys out. Okay. And that's it, folks. That's the whole summary. Like I said, we covered off a number of different things. We covered off 2023, 2024, talked about the housing markets, talked about some tax ideas. And again, I could talk for another hour, talk about more tax ideas, but again, these are the top ones that we've come across to be thinking about at this time of year. So I'm going to pause there. I'm going to open it up to I'm going to open it up for questions. I've already had a couple that have actually come through. So I'm going to go through that right now. Feel free to type it into the Q&A box. If you are on a computer, that's generally at the bottom. It'll say Q&A. Again, I think if you're on an iPad, I can't remember quite where that is, but again, if most of you are accessing off the desktop, then again, it will be at the bottom. Okay, perfect. So I have one. I have a question. Are T3s available from Revenue Canada in early April? Yeah, they should be actually available even before early April. They should be. I would assume they would be actually uploaded probably sometime in March. So, okay, I have another. I'm just going to read here. I have a screen on my right-hand side, so let me read this here. So I have a question here about commercial real estate, commercial properties, and it's a good question. So with commercial REITs, office REITs, essentially, I mean, I read a good article yesterday. You know, when you look at the newer offices that are being built or that are out there, you know, 90% of those types of buildings are occupied today. And the reason why is they're energy efficient, they're new, they're updated, air conditioning, all these various things. The older buildings are going to have a little bit more challenges. And, you know, and renewing, obviously, for commercial REITs are going to be a little bit more of a challenge because it eats into their cash flow. So I would actually think, you know, if I were to look at REITs in general, if I was going to own them, I would likely not own office REITs because, again, I think that's probably the biggest uncertainty. I think you're going to start to see office buildings maybe convert into maybe some other used or other use type property rather than an office building. You're likely going to get maybe them turn into, I don't know, residences, rental properties, or what have you. But yeah, like I said, I would stay away. I think from there, they're going to face similar challenges to any other REIT, any other sector that's going to be renewing this year. But I think above and beyond that, the challenge is going to be the type of building. And again, I think office commercial is going to be the tough one. So, all right. Sorry, I'm just scrolling down. Okay, I have another one here. Actually, somebody asked a question about GICs. What are my thoughts on GICs currently? And this comes up pretty regularly. With the expectation of interest rates to fall, GICs, 1 year GICs at least, the interest rate is actually falling. Okay, the yield that you get on it, and it makes sense because what happens essentially, your banks are trying to hedge the risk. You know, if we get 3 rate cuts, let's say we're at roughly, you know, let's say a GIC is at 5% today, easy math. If we get 3 rate cuts, you know, it might only be at 4.25% by the end of the year. So banks they want to be mindful of not paying too much interest in a lower interest rate environment. Okay, so what happens, instead of paying the going rate of, let's say, 5% today, they might only pay 4.8 or 4.9, 4.7 on a GIC, a 1 year GIC, because it's going to be a little bit less than market rate, but it's going to be higher than if the rates go down in the future, if that makes sense. So they try and blend it out. Now, I believe we're at a unique time right now where, you know, if inflation is plateauing, I think the rates are actually plateauing, and there's a gap. There's a spread, you know. Again, rates right now, if they're roughly at 5 and inflation is at roughly 3, we have the gap of roughly 2%. I think, like I said, there will be a short period of time where that will continue as we plateau, but there will be a time where generally your GIC will track very close to the inflation rate. So again, I think you need to be mindful. You need to actually look at your time frame. Locking in for 1 year might make sense for some folks. I think if you can get 4.6 to 5.2, I think is still pretty reasonable, despite it being 100% interest, but it might be the right thing for you. But if you have a longer time frame, then, like I said, you can look at dividend producing securities that actually pay, you know, better than what the GIC rate is, and has tax preferred income, or maybe you do a combination of them instead of the whole thing. So again, these are things that I think you need to be looking at, being mindful of. GICs have kind of served their purposes, but again, I don't believe they're going to be as attractive as we head in throughout the years. Okay, and again, if you have questions, you let me know. Another one I actually have here Okay, this is actually a really good one. So I didn't talk a lot about this, but it talks about geopolitical rates. Geopolitical risks. Sorry, not rates. Interest rates are on my mind. So geopolitical risks, obviously, the two biggest ones that we're all aware of, is the tension, obviously, between Russia, Ukraine. That has been ongoing. So long as nothing, out of the ordinary happens, I think it's all priced into the markets. It's when things happen that we don't anticipate that can really shake the markets. And then obviously what's going on in Israel as well. I mean, that's a sensitive subject. But again, that's been ongoing now for, a couple of months. Again, I think it's somewhat priced into the market. I think the one that probably has the biggest impact right now is what's going on in the Red Sea. Obviously, it has an ability to really disrupt, obviously energy, oil, and commodities. If you look at where oil has been just in the last little bit, it's up 7 to 10% since the actual conflict has started. Some folks are actually projecting that oil could actually balloon to 30% up higher from where it is today based on this ongoing conflict. Now, again, a lot of folks will say, yeah, well, that's oil and some of those other products, but it's not even that. It's, there are car companies, that are looking to get product to build cars that are not shipping out of there right now. Because what's happening is, instead of going through, the Red Sea, they're going around the long way to deliver that same product. And unfortunately, it takes longer. So there's delays. It also means that there's going to be increased costs to be able to actually deliver those products. So for some companies, they're actually pushing off their productivity because of this. So it can have a fairly significant impact, and it's just somewhat starting. So, it's ramping up. It's just yet another situation globally that could have a fairly significant impact on the market if it doesn't get resolved sooner than later. So that's something that we're watching quite closely. And because, again, we're still dealing with kind of the COVID slowdown. I know it's been 4 years, guys. 4 years in March for COVID. It's incredible that we're on the cusp of that anniversary. But one of the biggest drawbacks from it is, again, just the supply chain. I mean, we still see it today. Things are still slower. Things take longer. Order furniture. If you have a property or you're helping buy something for the kids or what have you, you can't go in often and buy furniture. You got to wait 3, 4, 5, 6 months for it now. This all stems, and it's just an example, by the way, but this stems obviously with what happened with COVID. Everything just takes longer nowadays. So add another bottleneck into that supply chain, and again, things will just get slow and prices will go up. And again, this leads into inflation. So it has this trickle down effect. So I think that's something that we just really need to be mindful of as well. So, okay. All right, folks, I went over by 3 minutes. I'm gonna wrap up here. Again, appreciate everybody jumping on the call. Like I said, we had a great turnout. By no surprise, everybody wanted to kill some time and not shovel snow. But regardless, have fun in the snow. If you're out there, be safe. And like I said, bundle up. And if anybody has any questions, please send us an email or give us a call and we'll go from there. So all the best, and we'll talk with everybody soon. Thank you. Take care.